Hello beginner forex traders, this is your boys back here, and guys, in today's video I'm going to show you 4 chart patterns that you need to make money. Guys, these chart patterns work so well, and I will give you the reasons why these chart patterns works so well. And not long ago I did a video whereby I talked about risk management 2.0, and guys, what are the deductions that I did in that video? Like I wasn't even aware of what I was doing because it was part of my strategy. You know, I was just doing it for doing sake, but it just played out because I applied a strategy that I did teach on this channel. All right, go and watch my video that is called Making Money Trading the Trend. Okay, so go and watch that video. It's on this channel, or I'll put it somewhere around this area. And guys, everything that you need, it's in it. All right, but in this video I'm going to talk about something very quite unique, and you will enjoy this video. So guys, stick to the very end of this video, and trust me, hey, I won't let you down. Okay, so if you're ready and excited like I am, let's not waste too much time. Let's get right straight into the video. Come on, let's do it. Okay guys, so let's go straight into the video. Okay, so guys, these 4 chart patterns that I'm going to give to you, okay, probably you may have heard it somewhere else, or maybe not. All right, the way I will deliver this whole message to you, it will let you see them in a total different perspective. All right, because most of the times what people do is, or a lot of traders on YouTube do, is they show you that, oh, use this chart pattern, and they never even break it down for you and some of the things to add to it to make it work well. Because indeed, truly indeed, these chart patterns, they do work, but how do they work? How do you make them work? It takes some understanding behind it, and I will give it to you in this video. Okay, so what are these 4 chart patterns? Okay, these 4 chart patterns that, guys, if you want to trade chart patterns, okay, or if you want to add chart patterns to your trading, these 4 chart patterns that you need to go with are the double top, the double bottom, okay, the head and shoulder, and the inverted head and shoulder. Okay, so if you don't know them, this is the double top, this is the double bottom, this is the head and shoulder, and this is the inverse head and shoulder. Okay, now guys, why am I saying that you should go with these 4 chart patterns? All right, I'll give you 4 reasons why as to go with these 4 chart patterns. Then I will take you to the chart and I will show you these chart patterns proving themselves, okay, with the strategy that I talk about in my video, the trend strategy. Okay, so now let's talk about, let me give you the first reason. Okay, so guys, the first reason behind why you should go with these 4 chart patterns that I talked to you about is because it is the market speaking to you. And the interesting thing and the funny thing about this communication that the market is giving to you, it's not gibberish. It's not something that you can't understand it, or it's hard to understand. No, it is crystal clear, guys. Like, you will see it very well. Okay, that is the one of the reason why you should go with these chart patterns that I told you. All right, because it is the market communicating to you directly as to what is going to be the next move that it will take. Okay, now in trading we deal with probabilities. All right, but the more something is proving itself to be working, then the more likely that thing will work in the next juncture. Okay, so let's move to the second reason why you guys should trust this pattern. Obviously, you can build a strategy around it. That is the whole idea here. All right, so now the second reason why you should go with this chart pattern, as I may have anticipated before, is because they've proven themselves to be formidable, okay, to be trusted. Okay, how? Go through historical data. Most of the times that you saw head and shoulder, what happened? The market went down. Most of the time that you saw a double bottom, what happened? The market went up. Most of the time that you saw an inverse head and shoulder, what happened? The market went up. Most of the times that you saw a double top, what happened? The market dropped down. Now that is what I'm talking about. So if history tells you that this is what happened, then you can trust it. Why? Because these chart patterns that we see, okay, are generated because behind the scene, humans' emotions is involved, and it is humans that runs the market. All right, and because it it's humans that runs the market, humans' actions are quite repetitive, you see. So that is why there is a tendency, or there is a likelihood or probability that every time that we see these chart patterns, they will play out the same way they did play out years past or some days ago. Are you getting me? That's why we can trust them. That's why they are formidable. All right. So you can scan through the historical data and see it for yourself, that you will see that these chart patterns have proven themselves to be working. All right. So let me give you the third reason why these chart patterns are the best and they can help you make money. Okay. So guys, the third reason why you can trust this chart pattern is because, guys, they are very strong. Why do I say they are very strong? They are very strong because it takes time for them to be built. All right. Now we are not talking about, some candlestick formation. You're not talking about some candlestick patterns. You're talking about chart patterns here. Like before you will see a chart patterns, it takes a lot of candles together to form this chart patterns. So that is why they are strong. So because they take time to be formed, it gives it this strength, or it makes it buoyant in a way that we can trust the next move that it will make. I don't know if what I said was quite clear. All right. So that is why I say that it is strong. You can trust it. Why? Because it took time for it to be built. All right. So guys, having given you the third point, let's go with the fourth point. All right. Then after the fourth point, I'll take you to my desktop and we will see these chart patterns playing out on live market. All right. Let's do it, guys. So why should you go with these chart patterns? All right. You should go with these chart patterns because of its simplicity. All right. How you can identify it in a simple manner. All right. So when I say why should you go with chart patterns, you should go with chart patterns because you can easily identify them. All right. You can easily identify them. Like it's not complicated to identify these chart patterns that I gave you. Double top, double bottom, a head and shoulder, an inverse head and shoulder. It is very easy to identify them. That is why you should go with them. Having said this, let's go on the monitor and let me show you something. All right. But I want to say something. All right. I want to give to you the bonus, okay, before we go to the monitor, so that when we go to the monitor, I will explain to you even the things that are in the bonus. All right. When we go on my desktop, things will be more clearer. Okay. So guys, once you learn these chart patterns, okay, what you have to do is learn them. Okay. 2, go on the chart, go on the market and go through historical data and see how many times they reoccur or they show themselves up in the market. All right. Just to have some proofs. Okay. Then the third thing is practice it. Okay. On live market. Okay. So what I mean is make sure you identify them on live market. Okay. So these other points, 3 or 4 points that I'm about to give to you is this. Guys, make sure you add Fibonacci. Big man Fibonacci. Do you know that Fibonacci 5061 zone? Bro man, that's a golden zone. That's where all the magic happens. All right. So learn to use Fibonacci. Okay. I will take you to the monitor and I will show you that one too as well. Okay. Then adopt a proper risk management. Okay. Guys, if you've not watched my video about risk management 2.1 and 2.0 elite, guys, make sure you watch those 2 videos. Watch the 1.0, then after you come and watch the 2.0. Very important. Okay. Now guys, once you have a good risk management, which I did explain in the 2.0, I want to add to it that whatever thing you are doing, make sure that you're good, your risk reward is good, because that one is, I think it's a little bit personal. You understand me? Because we might enter like the trend strategy that I gave. All right. Like the trend strategy that I gave on my channel, the more secure way that you will always make money with that trend strategy is to go for a risk to reward 1:1. Not to say that you can't get the risk to reward 1:3. You can get it a lot of times, but you are like, oh, I'm afraid, I'm more conservative, I don't want to risk much. Go for a risk to reward 1:1 and you will always 99% of the time make money with that strategy, with a risk to reward 1:1. Yes, I said it and I own it, and you can take that to the bank. All right. The second thing on that strategy is that you can even choose to go with a risk to reward 1:2. You understand me? That's where you've gathered enough confidence and you like with the strategy and you're like, man, I can stay in the market for a little bit. Do you understand me? Because it's all about tenacity. How much can you stay there? Are you getting my point? So that is why I'm saying that the risk to reward factor, it is more personal. Okay, so the most important thing is that you know how to use the strategy to make money. The most important thing is that you know how to identify the chart patterns, add Fibonacci to it, have a proper good risk to reward management. Okay, yes, risk management, having a good risk management. Then when it comes to the risk to reward factor, that one is more an optional type of thing. All right, so okay guys, so let's go on my desktop and let me show you what I was talking about. Okay, so here we are on my desktop, guys. If you watch my video, or if you've not watched my video called Risk Management 2.0, if you go and watch that video, you will see that at the time that I was making that video, the market was here, and I drew this same exact line. I've not moved it. This same exact line. You can go and check the video. I drew this same exact line, and I drew this line right on the market that day, signifying that if I was to enter into the market, I would have gone with a buy. All right, and lo and behold, in this video I'm talking with you guys about, guys, look, the market played out in a buy direction. This is to prove to you how strong that strategy, the trend strategy, is. All right, now let's look at, we don't want to lose sight. Okay, so let's look at the reason why we are here today. Okay, we are here today because we want to identify chart patterns. All right, listen guys, let's start from where I dropped you guys. Okay, so once we know, you see how I'm able to identify these patterns. Like, guys, that's why I say practice is important. All right, you know how the saying that they say practice make perfect. Yes, practice is important. All right, excuse me for that. All right, okay. I remember I was teaching one student of mine a time ago chart pattern, and I was teaching him the strategy to use behind chart pattern. It was like, oh, I saw something and it kind of like, it's not straight. It doesn't look like this. He said, it doesn't look straight like this. It doesn't look straight like this. And I said, bro, do you think the market will make it easy for you? No, the market won't make it easy for you. For all of you that you think that, oh man, I'm here to make money and the market, oh, it's easy, it's easy. No, the market won't make it easy for you, because the market wanna eat the little that you have. Feel me? That's why you have to train your eyes to be very, very technical. That's why we always advocate doing back testing, all right? So that you see different forms and shades and shapes of the same pattern. Okay, so look here, all right? Do you see this double bottom? All right, what happened the moment the double bottom happened here? Okay, what happened? Buy. Market went up. What did I tell you at the beginning of the video? Go and do your research and you will see that that is it. All right, now all right, let's add Fibonacci to it. Okay, so remember I told you about Fibo 60. Okay, so here is it. Beautiful, beautiful, beautiful. Let me bring it here. All right, check something. The market got into the 60 zone. It was playing around here. Then what happened? Boom, it skyrocketed. Okay, a bullish came in. We broke the structure. Okay, and guess what? The market remained up here. You see why it's important to add Fibonacci to it. You see, so here we are. The market rejected a lot in this Fibonacci 61 zone, then boom, it went all the way up. Okay, so the moment it returned on this zone, you would have entered into the market here. All right, I'm talking about if we saw the market creating in this zone, we would have entered into the market in this zone. We would have entered into the market somewhere around in this zone. All right, sorry, my bad. Before I said you would have entered in here. No, you don't enter in here. You enter somewhere around in this zone. All right, what I like to do is I always like to add chart patterns to it. All right, so you see here the market went all the way up here. Okay, all the way up here, came down here, went all the way up here, came down here again, and it dropped down, and it was on this zone. Okay, it was on this zone, playing above this zone. So if you can see, we are here, right? As we are all, I'll put it like we are on the support zone. All right, we are on the support zone because it was a previous resistance. Okay, it was a previous resistance. We broke it, and now it is a support. It has become a support zone. That is one way that you know that the market will go up. Okay, so you see a lot of rejection. You see a lot of rejection. Rejections are very, very key principles. I talk about rejections too in the trend market. All right, so Fibonacci. All right, you see how we apply Fibonacci. Okay, so Fibonacci gives us the confirmation that yes, the market will go up. Unfortunately, the candle that created here was too big. All right, if it was like a small bullish, okay, engulfing, or it was a variation, we would have jumped in right after it created somewhere here, and we would have put our stop loss below this region. All right, but because it was so big, all right, and that was the same incident that we found the last time when we were applying our trend strategy to it. When you go and watch the risk management 2.0, you will see it. All right, so when we see that this candle still is very, very big, we give it time so that it will drop back into the zone. All right, it will drop back into the zone. Now when you see this rejection here, all this rejection in this area, it tells you that it is a zone. Okay, so you draw your region. Okay, you draw your region. Okay, and that will be the area whereby you will enter into the market and put your stop loss below your region. Okay, don't draw the region too big if you are in a smaller time frame. Okay, like I am in right now. Okay, so we said we would have waited for the market to come, either touch the trend line again or the support and resistance. But guess what? It came on the trend line. We didn't get it. Okay, so that was the last time I was explaining this video. Okay, so I went ahead and did this explanation as to how to use risk to reward. Okay, because we were not getting this. Okay, then the market came here, rejected a couple of times. 1, 2, 3, 4. Okay, what are we going to be doing here? We want a variation candlestick or an engulfing. All right, now two things we can do here. Do you see that here we were not seeing any candlestick variation? Good. All right, but then here we got a candlestick variation on a support and resistance. I highly recommend that you go with a more conservative entry. Okay, so you see here this gum, boom, then we enter. All right, because this is a variation candle. Okay, for those that don't know a variation candle, go and watch that same trend strategy, and I talk about it in that video. Okay, so my stop loss will be right back here, and guess what? If let's say my stop loss was 20 pips, all right, 20 pips, where is 20 pips? Okay, good, 20 pips. So my stop loss would have been here, okay, and my take profit, if I was going for a risk to reward 1:2 or 1:3, if it was 1:2, I will be here, 40 pips, you see. So I would have gotten my profit. If it was 1:3, this region where the market previously was, okay. So risk to reward 1:3, 60 pips, boom, I'm out of the market. Anything else, I don't care. All right, so what did I do right now? What I just did right now is risk to reward ratio. Okay, risk to reward ratio. So in this case, we were risking 120 pips. We were risking 120 pips, okay, for a reward of 20 pips, okay, for a reward of either 2 pips, okay, 20 plus 20, 40, or 30 pips, okay, 60 pips, okay. So a risk to reward of 1:3, okay. Now risk management, go and watch for the aspect of risk management. Go and watch the video that I told you guys about. All right, now you can see we've applied Fibonacci, risk to reward. Go and watch the risk to reward, the risk management video, okay. And you've seen double bottom. Check this out. Check this out. What is this, guys? What is this? It's the inverse of this one. If this is the bottom, this is the top. This is what we mean by double top. All right? Are you getting it? You see that the market is going down. That is how it is. That's how it is. All right. So you wanted to get into the market, you would have drawn your zone here. All right. You would have drawn your zone somewhere around this area. All right. Keep it a little bit above. Make sure you are in a small time frame, so make sure it will be like 10 pips, not more. All right, keep it 10 pips. I hate this thing. Okay, keep it 10 pips. All right, good. You touch more area, touch here, and you touch here too as well. All right, so we could have jumped in here, or we'll wait for the market to come and retest this zone. Then we sell. Our stop loss will be above here, and we apply a risk to reward ratio. All right, guys, is it clear? So we've seen a double bottom and a double top. All right, now you will have to go and look for an inverse head and shoulder. Okay, and an inverse head and shoulder and head and shoulder. All right, so I'll leave that for you guys as a homework. Okay, guys, if you did enjoy this video, make sure you subscribe to the channel. Yeah, I know how the deal is. I mean, yeah, subscribe to the channel, but hit the like button too as well, and let me know in the comment section if you did enjoy the video. All right, and if there is any query, if there is anything that wasn't that much clear and you want me to help you with it, you can reach me out on Instagram, or you can put it in the comment section and I'll come through and I'll help you. All right, another thing is, make sure you like the video. If you want to add more to it, put it in the comment section. It could be a help to me. You feel me? Yeah, we are all learning, bro. We're learning in this industry. It's all about learning, everyday learning, bro. All right, so guys, thank you very much, and I hope you enjoyed this video. Make sure you share it with other people, and guys, hey, thank you. I approve this one too as well, and I will see you in the next video.
Just a quick update, all right, just to show you guys the prediction that we did on the market when we saw these two double top. All right, so lo and behold, the market went down just as we forecasted. All right, so yeah, that is it. Okay, this to prove to you that the chart patterns are very, very strong, and you can build a good strategy around it. All right, you just have to know what you are doing, and you can make money with it. All right, so yeah, just a quick update. I think you guys will remember that we were around here when we were doing the trading at the time. At the time of recording the first part of the video, I think the market was somewhere around here, and we drew this zone, and yeah, the market has dropped all the way down. So you could have jumped in with a risk to reward 1:3. See, so your entry somewhere here, and 15 pips. Or even if you went in for 20, let's say if you did 20, could have gotten 1:3. See, 60, here we are, right? Or 1:2. See, there we go. You have to make your money, then you are out of the market. All right, so that is that.